Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is November 4th, 2025, and we are taking a close look at pound sterling to US dollar, also known as cable. The currency pair is under significant pressure, hitting a 7-month low amid a confluence of negative factors for the British pound. Recent headlines are dominated by concerns over the UK's fiscal situation, with the Chancellor signaling hard choices ahead of the November 26th budget. This contrasts sharply with a hawkish tone from the US Federal Reserve, which is maintaining a cautious stance on rate cuts, thereby strengthening the US dollar. The divergence in monetary policy is a primary driver here, with markets speculating on potential rate cuts from the Bank of England while the Fed holds firm. This fundamental backdrop has created a powerful bearish sentiment for cable, which we'll see reflected directly in the charts. Now, let's pull up the daily chart to get the big picture. After a strong rally from the lows near 1.19 back in January, the price pushed impressively to a peak above 1.37 in late June. However, after a second attempt to reach those highs failed in September around the 1.367 mark, we've seen a dramatic reversal. This failure to make a new high formed a classic double-top pattern, which is a strong bearish reversal signal. Since that September peak, the selling pressure has been relentless, pushing the price down through several key support zones. The most critical level in play right now, as highlighted by multiple financial news outlets, is the 6-month support around 1.3140. Looking at the most recent candles, we can see that the price has just broken below this exact level in the past few sessions, closing yesterday at 1.3134. Let's zoom in on this recent downtrend to see how it unfolded. Here on the daily chart, focusing on the period from September 1st onwards, the story becomes crystal clear. You can see the peak and rejection in mid-September, followed by a series of large, impulsive bearish candles. Notice the significant drops on September 2nd, October 3rd, and more recently on October 29th, which saw price fall over 0.6%. Each of these moves demonstrates strong conviction from sellers, likely fueled by the strengthening US dollar and weakening UK economic outlook we discussed earlier. The break below the 1.34 level in early October was a major technical warning, as this area had previously acted as solid support. Now, all eyes are on whether this break below 1.3140 is decisive. Switching to the hourly chart, we can examine the character of the price action during the decline in mid-October. Although this data is from a couple of weeks ago, it clearly illustrates the structure of the downtrend. We can observe a classic pattern of lower highs and lower lows, with bounces being shallow and quickly sold into. This type of price action is typical of a market with strong underlying bearish momentum, where sellers are in firm control. Any short-term rallies were consistently met with renewed selling pressure, failing to establish any meaningful support. For the most immediate price action, let's move to the 15-minute chart, which covers the last few trading days up to November 3rd. Here we can see the intense battle happening right at our critical 1.3140 level. Price has been chopping back and forth across this line, with neither bulls nor bears able to gain a decisive advantage just yet. There have been multiple attempts to push lower, followed by small, weak-looking bounces. This indicates a period of indecision, but in the context of a strong downtrend, such consolidation often resolves to the downside. We are not seeing any signs of a strong reversal or buying pressure emerging at this support level yet. Traders are likely waiting for a catalyst to trigger the next significant move away from this pivotal point. Let's pull back to the daily chart one last time to synthesize all this information and discuss potential scenarios. To recap, the key price levels are clear. The most important level is the support we are currently testing, 1.3140. If this level fails to hold on a daily closing basis, the bearish scenario points towards the next major support zones mentioned in market analysis, around 1.2940 and then potentially 1.2740. On the upside, any bounce will face initial resistance near the 1.33 area. However, the most significant resistance is the old support level around 1.34, which would need to be reclaimed to neutralize the immediate bearish outlook. Given the powerful fundamental drivers and the bearish technical structure, the path of least resistance appears to be lower. I would assign a roughly 70% probability to the bearish scenario, where we see a sustained break below 1.3140 and a move towards 1.2940 in the coming weeks. This would be reinforced by any further hawkish commentary from the Fed or negative news surrounding the UK's budget announcement on November 26th. The bullish scenario, with a 30% probability, would require a strong rejection of these lows. For this to happen, we would need to see a significant positive catalyst for the pound or a sudden weakening of the US dollar. A break and hold back above 1.3250 would be the first sign that bulls are regaining some control. In summary, pound sterling to US dollar is at a critical make or break point. Keep a close eye on whether the price can reclaim 1.3140 or if sellers confirm the breakdown with a decisive move lower. And be mindful of the news flow, especially concerning central bank policies and the upcoming UK fiscal statement. Thank you for watching this analysis on Explain the Charts. Please remember, this content is for informational purposes only and is not financial advice. Always conduct your own thorough research and risk assessment before making any investment decisions.